What's going on, everyone? I'm Ali, and welcome to Stock Scope Live, the place where we cut through the Wall Street BS and give you the real talk about making money. Whether you're investing your first dollar or your millionth, we're here to help you win. Let's jump in. The Federal Reserve is about to make one of the most important decisions of 2025, and it could make or break your portfolio. With markets pricing in an 85% chance of a rate cut in September, the stakes have never been higher. I'm going to break down exactly what happens to your investments, whether Powell cuts rates or keeps them steady. And trust me, you need to hear this before the decision drops. We'll cover the immediate market reactions, which stocks could soar or crash, and most importantly, how you can position your portfolio right now. Let's dive in. All right, here's where we stand. Fed Chair Jerome Powell is facing a critical decision at the September FOMC meeting. Markets are currently pricing in an 85 probability of a 25 basis point rate cut. That's a pretty high expectation. Now, here's why this matters so much. We've been in a high rate environment for over a year, with the Fed funds rate sitting in restrictive levels. The economy is showing mixed signals, inflation is cooling, but the job market is softening. Powell's stuck between a rock and a hard place. But here's the kicker. When markets have such high expectations, the reactions to any surprise could be massive. We're talking about trillions of dollars moving based on one decision. So, what happens in each scenario? Let's break it down. First, let's talk about the scenario that could absolutely shock the markets. If Powell decides to hold rates steady, if this happens, buckle up. Based on historical data, we'd likely see the following. The S&P 500 could drop 2 to 3% immediately. We saw this exact pattern in December 2024. Small cap stocks would get absolutely hammered. They're the most rate sensitive. Tech and growth stocks would sell off hard as higher rates make their future cash flows less valuable. The broader market impact is it doesn't stop there. Treasury yields would spike 10 to 20 basis points across the board. The dollar would rocket higher. Great if you're traveling overseas, terrible if you own international stocks or commodities. Now let's talk about the recovery timeline. Here's the thing. These sell-offs can recover if the economic data stays strong. But if we start seeing unemployment tick up while rates stay high, that's a recipe for a prolonged decline in the markets. Now let's flip the script. What if Powell delivers the rate cut everyone's expecting? The market would celebrate. This is where things get interesting. History shows us that the rate cutting cycle can be massive wealth creators. We're talking about average gains of 30% during the 9 Fed cutting cycles since 1974. The immediate winners will be small cap stocks would absolutely explode. We're talking potential 2 to 5% gains in a single session. The Russell 2000 has already rallied 4% this week just on the hope of rate cuts. But here's where it gets really tactical. We'd see a massive sector rotation. Utilities and real estate would surge as their dividends become more attractive than bonds. Small caps would outperform large caps by potentially 6 to 10% over the following months. The dollar would weaken, making international investments and commodities more attractive. The big picture is that lower rates mean cheaper money for everyone. Businesses can expand, consumers can spend, the whole economy gets a shot in the arm, but it won't last for long. This is critical. The size of the cut matters. A 25 basis point cut signals confidence, but a 50 basis point cut, well, that might make the markets think that Powell knows something that we don't know about the economy. Now, let's talk about how do you position for this. Here's my take. If you think rates are getting cut, look at small cap ETFs like the Russell 2000, consider utility and real estate stocks. International exposure could pay off if the dollar weakens. Maybe trim some of those mega cap tech positions that everyone's already crowded into. If you're preparing for no cut, keep some cash ready for the dip, because we know, based on historical data, that August, September, and October are usually the downturn, the bear market. Now, financial stocks might actually benefit from higher rates, because they're longer term positions. A strong dollar plays like domestic large caps could outperform. Now, risk management, here's where you need to pay attention. And this is probably the most important thing. Don't bet everything on one outcome. The market can stay irrational longer than you can stay solvent. Use position sizing and don't risk money you can't afford to lose. Remember, we're not just talking about a 1 day move. Rate cutting cycles can last months or even years, creating sustained trends across different asset classes. Look, whether Powell cuts or holds, this decision is going to move markets in a big way. Rate cuts could spark a small cap rally and sector rotation like we haven't seen in years. But holding steady might trigger the exact opposite, a flight to quality and mega cap safety. My advice: stay informed, stay diversified. And remember, the best opportunities come from the biggest uncertainties. What do you think Powell's going to do? Are you positioning for cuts or preparing for disappointment? Drop your thoughts in the comments below. I read every single one. If this breakdown helped you understand what's coming, smash the like button and subscribe for more market analysis. We've got some crazy times ahead in the markets, and I'll be here to break it all down for you. Until next time, stay smart, stay invested, and remember, the Fed giveth and the Fed taketh away. See you in the next one.